What's going on, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Albaum, and today I'm joined by Ed Fernandez, the President and CEO of 1031 Crowdfunding. And he's going to be talking to us today about the state of the economy, the market, and his company, 1031 Crowdfunding, and how we all can take advantage of crowdfunding 1031 exchanges. So let's get into it. Ed, what's going on, man? Thanks so much for coming on and hanging out with me today. I appreciate it.
No problem, Michael. Thank you so much for having me.
No, it's really my pleasure. I am super excited to chat with you because you've got a really cool company doing some pretty cool things. So I know a little bit about it, but for all of our listeners who aren't familiar with 1031 crowdfunding, give us a little bit of background. What is it that y'all are doing?
Sure. So what we're doing is we're taking real estate, packaging it up, and selling it to investors in little pieces. For those investors that are either tired of the tenants, the toilets, and the trash, or they run out of this 45-day ID period that you have to actually do per the IRS. And so if you're looking for institutional real estate, but you really don't want to go running around trying to find your own property in this limited period of time, you can come to 1031 Crowdfunding, where we have a slew of institutional property for those investors who are looking to be passive and to defer their taxes through a 1031 exchange.
Man, I love it. We are definitely going to come dig deeper into that because I was under the assumption that you couldn't 1031 into a passive investment. So we've got a lot to talk about. But before we get there, I would love if you could give us a little bit of insight into where you see us currently in today's housing market with all the stuff we got going on. We're recording this towards the latter half of September in 2022. What's going on, man?
Well, as you know, yesterday the Feds hiked rates again to another 75 basis points.
Yep.
And so what they're trying to do, obviously, and it's currently not working, by the way, they're trying to slow down the housing market. But with money continuing to flood the economy, real estate prices are still exceeding and going up, and people can't afford real estate or housing because interest rates are going up.
Right.
So we're in a weird market today. I can say we can go back to 1991, 1992 and kind of look at that market. Very similar type of events that are occurring today.
Okay. And for all of our listeners that weren't plugged into the real estate market back then, what was going on back then?
So back then it was the tech boom, right? Remember the tech bubble that blew up?
Yeah.
Prior to that event occurring, interest rates on loans were double digits, 12, 14%. And people were still borrowing and buying houses and getting involved in real estate. But then the bubble burst in the tech industry, and all that money flooded into real estate. And that's where you had all this appreciation on the real estate side. So in today's market, even though we're not in double-digit interest rates are higher than what real estate is producing. So we're not as bad as we were, but we're actually pretty close to where, and who knows, we might get there if the Feds keep doing that. So those are the similarities where interest rates exceeded yields on real estate and real estate just kept going up.
Yeah. That's so interesting. I mean, I remember hearing about those double digit interest rates, but I also have to think back, and you could go park your money in a bank CD and make 6, 7, 8, 9%, which now is unheard of. So it's, again, we have these super high interest rates, but you can't make a yield letting your money sit in the bank. It's getting eroded by the high inflation. So it's a really unique time.
And I'm glad you brought that up. You know, what's very interesting is that Treasury bills, now you could buy a federal-backed Treasury bill, fully liquid, and get 4%, where real estate is producing 3 and 3.5%. So you're kind of seeing what's going on in this market.
Yeah. Where do you think we're headed? I want you to break out your crystal ball, change the batteries out, put fresh ones in there. What's going on in the next 2-3 years?
You know, it's a weird market. I'm not going to get into the political frying pan of who's doing what.
Yeah.
Right. But if money continues to flood this economy, I don't know how you put on the brakes on inflation if that continues to happen. So what has to happen, and what I hope happens, is that money tightens up so that the feds can kind of slow down and we can get real estate to a level where people can still buy a home. The millennials, those are the first time home buyers, and investors just can still get a yield. I don't see that happening at least for another 2 years. That's where I think we're headed,
Hmm.
but we'll wait and see.
Okay. And are you thinking that the interest rate hike is going to continue along that 2 year frame, or are we kind of plateauing and we just have to wait a little bit longer for the effects to take hold?
Well, if feds continue to raise interest rates, then now we're going to go into a recession. And how do we come
Yeah.
out of that? So it's a fine line of how much to push and how much not to push. So we just got to wait and see. Look, if I had a crystal ball and I can tell you exactly what is going on, I would not be on this call. I'd be on my 200-foot yacht in Monaco watching F1. Okay? So I'm just letting you know.
Totally. Yeah, that's a great point to make. All right. Well, I am very curious to see how it all shakes out, I think, as are many others. But Ed, let's transition here and talk about 1031 crowdfunding.
Okay.
So someone has an asset to sell. They've seen the skyrocketing appreciation. And let's just walk through it like some numbers as an example, because I find that makes the conversation a little bit more concrete. Someone's property is worth $1 million. They got 400,000 in debt on it, and they want to go 1031 the thing. So they sell it for $1 million. 1031 rule says they got to buy something for at least $1 million, if not more. Where does 1031 crowdfunding come into play here? Does someone have to bring additional 400K that was in debt to the table to invest and have a proper 1031? How does that work?
No, absolutely not. So one of the biggest things of a 1031 exchange is what we call closing risk, right?
Okay.
And so you have 45 days to try to find something. And that's not, there's holidays, weekends, that all counts, right? So you're out there pounding the pavement, trying to find a replacement property within that 45-day period, which makes it very difficult. So in using your example, if an investor had $1 million sale with $400,000 of debt, they can invest as long as they're an accredited investor, and let me define that, either an annual income of $200,000 a year for an individual, $300,000 per couple, or $1 million net worth, excluding the home you live in. You can come to our website, and at any given time, we have anywhere between 30 to 50 different options to choose from. And these investments are called Delaware Statutory Trust. The term we use is DST, been around since 2004, directly on the IRS website. And really what the DST is very similar to a living or family trust, where there's a trustee managing a trust for the beneficiaries. You as an investor are a beneficial owner of a trust that's on title of real property. Okay. So it could be a $50 million apartment building, a $100 million Amazon distribution center. And for as little as $25,000, you can own a piece of this big property, write off all your expenses like you're doing today on your Schedule E, get paid cash flow on a monthly basis every 15th of the month. And when the property is sold, all the investors get 100% of the upside, and you're still in another 1031 exchange. So that's what we do. Those investors that are looking for passive investments, tired of the tenants and toilets in the trash, or running out of time, those are the ones that give us a call.
Yeah, no, that makes total sense. And it sounds awesome. So if we go back to our example of the $1 million and the 400K in debt, how does it work? Because like my understanding is if I'm selling something for $1 million, I got to go replace that with $1 million of property. So if I go invest with you all, do I have to bring the extra 400,000? How does that work?
Nope. Here's how it works. I'll give you an analogy. So let's say I'm a trustee. I'm going to go out and buy a $20 million apartment building. And I'm going to create this product.
Okay.
As the trustee, I'm going to the bank. They're approving me as the warm body, and they're underwriting the real estate. And let's say they lend me $10 million. I'm the one that signs on the bad boy carve-outs, and I'm the one that signs on the loan. So now I have $10 million of debt. I need another 10 million in cash. So I write the check for 10 million and I close the property inside that trust. So to make the numbers easy, let's just call it 50% LTV or loan to value. Okay.
Yeah.
And so let's say you sold your property for $1 million and you paid off the loan and you got $500,000 in cash and you got to buy something for $1 million or greater. Well, when you invest in the DST already has a 50% loan on it. And what happens is that it applies that debt to your position along with the $500,000 of cash that you invested. Now at closing, you own $1 million of this $20 million property, which allows you to satisfy your exchange.
No way.
Yeah, that's how it works.
Everyone watching this video just watched my brain explode. That is wild. That's how it super works. Cool. All right. I dig it. And can people invest using an entity? So like if I have an LLC that I own this property in that I'm now selling, I need to keep that same entity, right, as my purchasing, as my up leg for the new property. Can folks use their entities to invest with you all?
Shoot, Michael, send me your resume. I should be hiring you real quick here. Absolutely. So you have to use the same tax ID number, right? So one of the things we do in process in talking to investors is we ask them, are you owning this as an individual, an LLC, a trust? And based on whatever tax ID number they're using on the sale of the property, that tax ID number is the purchaser of this DST. So yes, you have to invest the way you sold.
I love it. And Ed, I know you said you're passing on cash flows and 100% of the upside, which is insane. We're going to talk about that in a minute. But are you also passing along depreciation to the investors?
Absolutely. So whatever remaining basis they have from the sale will carry forward to this investment. And based on the asset type, if it's an apartment building or residential, 27 and a half years, or commercial 39 years, yes, depreciation will carry forward. In addition to that, some of the opportunities have what's called a cost segregation analysis done on it, where you accelerate the depreciation all on the personal property in the first year, which is a huge help to shelter cash flow from tax.
Yeah, I love it. I've done several of those, and it's just been amazing to see what my taxes look like post cost seg.
It's good stuff.
Ed, getting back just for a minute on the accredited investor designation, because it's a question I'm realizing I've had for a while. And we always joke in the podcast, they're super self-serving. I get to get educated here along with all of our listeners. We talked about the requirement having 200K as a single or 300K as a couple for the last 2 years. Is that adjusted gross income or is that net?
Adjusted.
Okay.
That's adjusted. And here's why that's required. It's because the investments in a DST are illiquid.
Right.
So the regulatory environment wants to make sure that if you do have a financial emergency, that you have other funds to go after and it doesn't drastically affect your life because you earn an investment that's illiquid. So that's why the requirement's there. Yeah,
that makes sense. And the alternative way to qualify is having $1 million net worth or more, right?
Correct. Or let's say you're in the financial services industry and your securities license and you don't have the net worth or the income because of your professionalism and the designations that you hold, that also actually qualifies as an accredited investor.
Okay, good to know. I was going to say, yeah, because it could be kind of interesting. Speaking about cost segregation studies, if someone's got great income, but also has a great tax strategist, their AGI is probably going to be zero if they know what they're doing. And so that they could get discredited that way. But the net worth piece probably comes into play more often than the income piece, I'd imagine.
It does. Yeah, because we deal, our client profile is anywhere between 55 to 90 years old.
Okay.
And so they're always, they don't have the income, but they definitely have the net worth.
Yeah. Okay. Why is that, Ed? Why is your target demo in that age bracket?
It's because if you're younger, I'm a control freak, right? I want to control everything. When you're younger, you want to control your destiny. So most younger real estate investors go buy their own deal, they manage their own deal, and they live or die with their performance. Mm-hmm. But when you get a little older and you've already built up your net worth, you get tired of those tenants and those toilets and those trash, right? And so you're looking for a passive way to continue to kick that can down the street, i.e. taxes. And so normally the demographic is 55 years or older. They're kind of slowing down on their real estate investment portfolios.
Yeah, and that makes total sense. And so talk to us a little bit about what the exit looks like on some of your deals. Because I was looking at your website before we hopped on, and I noticed you have some triple net stuff. So I'm just curious, how are you exiting those assets?
Sure. So it's got to be accretive to the beneficial owner or the investors. I would say triple net lease stuff, those are bonds. If you're looking for a Walgreens, a Dollar General, and Amazon, you shouldn't expect appreciation on those opportunities. You should just expect that coupon plus getting your money back, right? If you're looking for appreciation, which I would call more like a dividend stock, that would be a multi-tenant asset, apartments, senior housing, student housing, self-storage, where you have the ability to mark rents to market, which gives you that appreciation. So the exit really is going to be based on the economics. Is or are the investors making money? If they're not making money, there's no reason to sell because it's still producing the cash flow, right?
Right.
So as soon as the property starts appreciation to a point where the sponsor or the trustee feels, okay, it's time to sell, that's the exit. You put it on the open market, you got a real estate broker, you get the offers coming in, and then you pick the best offer and you sell the property.
Love it. And are you all targeting value add type of stuff, or are you getting stabilized assets? What does the mix look like?
So the DST cannot use value add assets, meaning it can't move walls. It has to be stabilized assets. Unlike a tenant in common,
right?
Tenant in common, you can do that,
Yeah,
right?
Yeah.
So the DST is all stabilized assets. And when I say stabilized, it's either, if it's multi-tenant, that's 90% plus occupancy. And if it's single tenant, triple net, investment grade tenant, corporately guaranteeing leases.
And is that regulated by the DST? I mean, is that a requirement of the entity structure that you're using?
That is the structure. Yes, sir. That's the structure, because if you disqualify the structure, you disqualify the exchange, and now people pay taxes, right, because it's not approved by the IRS.
Interesting. So the IRS is actually dictating what type of asset you can own in order to get this 1031 designation and benefits.
Yeah, if there's a specific structure and a specific way that needs to be structured. That's why a DST should have a legal tax opinion attached to it from your securities lawyers to show that the structure is complying with the approved structure, that it should not be challenged if you invest and qualify for the deferral of tax via 1031.
Interesting. Are there other vehicles out there that you could do something similar but have a value add component?
Tenant in common, a TIC. We call it a TIC. The similarities are very similar to the point to where you own a fraction of a piece of property. The differences are huge. Tenant in commons, the investors make all the investment decisions. A tenant in common can have a capital call. A tenant in common can use non-stabilized assets. A tenant in common can leverage the property. And so back in 2004, 5, 6, and 7, the tenant in common was the most primary way of syndicating 1031 exchanges. Yeah. But then, and so, everyone is going to agree as far as the investors are concerned when real estate goes up. But in 2008, Great Recession, you have savvy investors, not so savvy investors. It's called herding the cats. They disagreed on everything, right? And so about $6.5 billion went into receivership by TICs. And so banks will not lend to a tenant in common structure. So your question previously of how do I replace the debt would not happen in a tenant in common. That's why more tenant in common deals are all cash. And the way they address it to investors is, hey, it's all cash, no foreclosure risk. Oh, and by the way, we're going to lever you up, pull the cash out, and get it back to you tax-free. Well, that's what happened in 2008. and everyone lost their money. So ticks in our business is a 4-letter word.
Very interesting. Okay, this is really good to know, Ed. I'm curious, and maybe some of our listeners are as well, because the investors are getting the cash flow. The investors are getting 100% of the upside. You're doing all the work. How does 1031 crowdfunding make money? How do you all get paid?
So it's aggregating a portfolio. So yeah, we charge an acquisition fee, right? Anywhere between 2 to 4% upfront. And then we also get asset management fees. It's anywhere between 0.5% to 1% off of the cash flow. But you really don't get rich doing that. But the idea as a sponsor is if you're managing $5 billion worth of assets and you're charging a 1% asset management fee, you're making $50 million a year just unfortunately watching paint dry.
Right.
Right.
It's not a bad business model.
It's not a bad business model, but there's a lot of work to it. I'm kind of, dumbing it down, but that's how sponsors make their money.
Okay. All right. This is great. If someone is considering investing with 1031 crowdfunding or a different syndication, what are some things that they should be looking for? How do they go and educate themselves about the sponsor and about the deal?
That's a big deal right there. And that's a great question because these deals have an upfront expense. We call it the load, right? And even though the load doesn't affect an investor's capital account, so if you put $1 million in, you're getting credit for the whole million and your cash flow is based on that whole million. The problem is that you overpaid for that property. So let's give you that $20 million example that I used earlier, right? Let's say there's a 10% load on it. Even though I bought it for $20 million, I have to offer it to you for $22 million. And even though your capital account is not affected, it's when you sell the real estate when that becomes material. And so you need to make sure that the real estate can appreciate above its expenses before entertaining a sale, right? So that at least you come out at par. If you're going to invest in these things and you're using a financial advisor to advise you to do this, the most important question you should ask is, Mr. Advisor, when does this investment overcome its upfront expenses? And if that guy is any good, he should be able to tell you that.
Yeah.
That's the most important thing when it comes to investing in these DSTs.
Yeah. That's a super great question to be armed with. And so are most folks who are investing with you coming to you all via their advisors or via their team, or are they individuals? I mean, how do you find most of your clients?
So, we do a lot of marketing, right? So we do a lot of SEO, a lot of SEM. I do things like this. My PR team is working. So we get anywhere between 500 to 700 new registrations a month on our website. And we currently have about 60,000 registered investors to date. And so they just Google 1031 exchanges and we pop up. So we don't use the financial services industry to distribute these products, even though we are in that service. But people would normally just find us on their own, or an attorney might say, a CPA might say, their friends might have used us. We have wonderful Google reviews. They just find us. That's how they get to us.
Yeah. Okay. That makes a lot of sense. Ed, I'm wondering if you can shed light on your worst deal ever, how it went wrong and what happened.
That's so 2020, on the east coast of Florida, an apartment building got hit twice by hurricanes within 3 weeks. Okay. And you probably, it's right that time when Maria was coming and all that stuff. The property got flooded. 50% of the units became uninhabitable. Cash flow stopped to investors.
Right.
Enough cash flow to pay debt service. And then you had to get to the insurance companies and get the catastrophic damage insurance payment and the renter's interruption insurance payment. And remember, I told you in a DST, you can't do construction, right? So how do you fix the units, right? So there's a term called a springing LLC that's in every single DST PPM, or private placement memorandum. And what that means is that you dissolve the DST and now you're a member of an LLC. Non-taxable event. Your exchange is still good.
Okay.
But now in an LLC, You can do construction, you can modify loans, you can do all these things to fix the property, right?
Yeah.
So you go and you start fixing the property, you release the property, reinstate cash flow, right? But the issue is you can't go your separate way anymore. You're in an LLC. So the entire LLC has to do an exchange or not. So they don't want to mess up their 1031. So the LLC sells the property, does an exchange into another property, and then 2 years later, the term's called safe harbor, you can convert it back into a DST, and then everyone can go their separate ways when the property sells. That is the worst deal that has happened since I've been doing this.
And did the insurance proceeds cover all of your expenses enough and your business interruption to kind of make you guys whole during the process?
Yeah, absolutely. So even though the time lane was delayed, the investors did very, very well. They just lost cash flow for about a year.
Yeah.
But then when the property was sold, they did well.
Yeah. I love it. I love it. And that's one of the things I really love about real estate investing as a whole is if you understand what you're doing, the downside just isn't that scary.
Yeah, agreed. I mean, dirt is never going to go to zero.
Right.
It's just not going to happen.
Right. Right. Man, twice in 3 weeks. I mean, the only thing that I've heard of comparable to that, I'm in the midst of a redevelopment project, and I had 2 fires in the same building a week apart.
Oh,
during the course of construction.
Wow. Oh, that's not good.
It sucked. I'll tell you that much. It sucked. Oh, man. Ed, this has been super fun, man. If people want to find out more about you, continue the conversation, invest with you all, what's the best way for them to do that and get a hold of you?
So you can go to 1031crowdfunding.com, like a crowd of people, not a crown on your head, right? Or you can dial our number, 844-533-1031, and you'll be able to find us.
Good stuff. Well, hey, thanks again for coming on and sharing and helping educate our folks. We'll definitely chat soon.
Michael, thank you so much. Looking forward to hearing back from you in the future.
Take care.
Alrighty. Thank you.
All right, everyone, that was our episode. A big thank you to Ed for coming on. Super interesting stuff. I learned a ton. If you are in the middle of a 1031 or thinking about it, definitely an interesting option to take advantage of. As always, if you enjoyed the episode, feel free to leave us a rating or a review wherever it is you get your podcasts. And we look forward to seeing you on the next one. Happy investing.